The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Small Business Tuesday continues with Your Money, Your Call.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. And if you have a question about shares, our phone lines are open right now on 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. It's the very first show of the year, and what a year 2015 was, and hopefully a better year for 2016 for traders and investors. In fact, if we have a look at last year, we saw the market down by 1.2%, but it was mainly the blue chips that were affected. If we have a look across the mid-cap and the small-cap market, we actually saw gains of around about 8%. So plenty to talk about today, and joining me to talk about all of these things and more is John Athanasiou from Redleaf Securities and also Gary Burton from FP Markets. Now, we'll be here for the next 2 hours. It's a movie-length show. We'll be answering your questions, so please feel free to call in, and welcome to our panel for the 2 hours. I mean, just having a look at last year, first of all, it was a hard year for a lot of investors and traders out there. Some big movements down for traders, Gary. That sort of seemed to come out of the blue. And for investors, the big blue chips that you usually rely on, the big four banks, Telstra and the miners, really not powering along too well. So, I mean, Gary, just looking at 2015, are there any lessons that you've learned? What did you take away?
It took away, I was, and I'm quite vocal about it, quite surprised about how deep this bear market has run in the metals, in the base metals area, through the nickel market, copper market, how they've remained so low for so long, and also in the iron ore, but oil as well. I thought we would have seen a better bounce in oil, particularly given the Middle East issues. But what we've seen is it really has, 2015 was a stock picker's year, and we saw, as you mentioned, the middle of the market, the mid caps and the small ordinaries really move along, and that's where the gains were. If you string 2014 and 2015 together, really 2015 was an extension of 2014. So the healthcare sector really continued to outperform the rest of the market with technology and.
Okay, and just putting you on the spot, Gary, because I think the last 3 years, healthcare's featured in the top 1 or 2 top performing sectors of the year. Does it have more legs?
You would think so, because there's nothing within the healthcare sector, there are stocks that have really underperformed, like Primary Health, and stocks that have really outperformed. And this is one of the issues with the indexes, is we have this market cap weighting type of index rather than a cash index. So you need to look inside the individual indexes and find individual stocks that really interest you and are going the way you want them to.
Sure, and I think that's been the case with the whole market, that on an index level, we haven't seen the market performing well, but individual stock performance, there's been some outstanding ones. Bellamy's up by 700% in the past year, Blackmore's up by 500%. I mean, John, it's a difficult market to position clients' portfolios in, because you know, the smaller cap end isn't always as liquid or as big. So what have you been doing with clients' portfolios in the past year?
We've been looking at specific sectors that we believe that will benefit from this kind of environment. So right now there's money flowing towards the technology sector as investors are moving their risk capital away from the resource sector to the technology sector. And we're looking at macro plays. For example, the vitamins did very well last year. That's because of the policies implemented by China. Going back to the question of what was the big lesson of 2015, the number one lesson for all investors out there is don't fight the short sellers. There's a great website called shortman.com.au which shows you the top 20 short companies on the ASX. I encourage investors to stay away from those companies. Okay. You don't want to be in a Dick's Mix situation or a Slater and Gordon's.
And just coming back to Dick Smith and talking a little bit more short term about the market, I mean, this week has been a very difficult one. We've seen Dick Smith going into receivership and disappointing for a lot of investors out there, especially given that it's only re-hit the market for the last 2 years, having been bought out by private equity and then refloated on the market once again by private equity. So I might start off with Gary. I mean, in this Dick Smith situation, are there any warning signs technically that you're, with a distressed company, besides the share price falling down, are there any extra signals that you can?
Well, if you look at it short term or long term, if you take we'll deal with the short term thing first. If you get a profit warning out of a company and the stock actually gaps, makes a technical gap in the price chart and fails to fill that gap very quickly, you could basically say you've got a top in place right there. And we saw that with Slater and Gordon, where it gapped out of $5 into $4.35, never went back and filled the gap, and it's fallen away ever since. And the same with Dick Smith, that occurred. Dick Smith, when it listed, never really made new highs in the months following that listing, and just traded sideways and eventually broke the support levels and fell into 35 cents where it is. So in the short term, you're looking for the price gap out of some sort of warning or a change in sentiment towards that stock, and in the broader term, you're looking for really broad patterns that in the weekly charts, long-term charts, that set lower highs along the way, and we've seen a number of stocks particularly do that last year.
Okay, so you've seen this gap down that doesn't get filled and constantly tends to fall away. Looking at Dick Smith, one of the problems I think the market had was that it wasn't really aware of what the actual covenants were, and of course when the banks and the lenders came knocking on the door, it was game over. It kind of reminds me a little bit around Slater and Gordon, where we don't know exactly what the banking covenants are, so it's really unclear when that pin might be pulled. Are you worried about Slater and Gordon at all, or are there any other stocks that you'd be worried about in companies? I
am worried about Slater and Gordon because it is on that shortman.com.au list as a top shorted company still. In relation to Slater and Gordon, in relation to Dick Smith, we have to bear in mind it was only back in October when the CEO said we had a safe and strong balance sheet. It doesn't look that safe and secure right now as we speak. So the lesson born out of this is, as soon as a CEO says something and it doesn't meet expectation, it's best to avoid that particular stock until the company eventually turns things around, if they ever do. If that means losing 5-10% of the upside, so be it. You'd rather be safe than sorry.
Okay, so plenty to talk about on today's show. We'll get some more tips from our panel in how to manage 2016 and what they foresee for 2016. Let's, though, go to our first call. We've got Adrian from Sydney on the line. Adrian, Happy New Year. What's your question tonight?
Yes, thank you. 2 shares I'd want some information or advice on, please. The first one is Retail Food and what their gearing may be. And the other share is Flexi Group. Could I have your views, gentlemen, on these 2 shares?
Sure. So we're having a look at Retail Food Group and Flexi Group. We'll start off with Retail Food Group. I mean, it is a company in that retailing space. It owns all the yummy things from Donut King to Michelle's Patisserie, Gloria Jeans, Brumbies. So donuts, bread, a lot of coffee these days. Looking at the share price, and it's really struggled over the past year. It's down 18% in what's been a pretty difficult market. It seems to be finding a base there, but looking pretty undervalued compared to the rest of the market. So let's start off with the technical view. Historical dividend yield of 5%, a forward-looking dividend yield of 6.1%. P/E ratio is around 21 at the moment. What do you think, Gary?
It is back, as you mentioned, it is back at its support level around this $4.50 to $4.60. This is what we were talking about a moment ago when companies are in trouble. You can see on this weekly chart, this stock really fell out of favour about the middle of this year, set a lower high on the weekly chart and simply fell away into this support level. So as you mentioned, Julia, when stocks find support like this, it's got a little what we call a double bottom in there over the November-October period, and if it holds up above, I would think around 470, if it starts to trade back over there, you might look back and say, well, there's the base, and this might now be worth having a look at. But in the retail sector, as we've just mentioned, the Shortman website has the top 3 shorted stocks in Australia are retailers, which is Metcash and Myers and and JB Hi-Fi, would you believe? But so this retail group, really the market's really waiting to see them produce some numbers before I think it marks it up.
Okay, and looking at Retail Food Group, I guess the premise behind it is that they have made plenty of acquisitions, but the operating cash flow should help to reduce the debt. Looking at a company like this, are you concerned with the amount of debt they have? What do you think of its business model?
I'm always concerned of a business that grows through acquisition. You'd rather prefer an organisation that grows through internal growth model as opposed to keep acquiring the next thing. Another thing about Retail Food Group, and it's quite appropriate at this time of year when we're all considering about our New Year's resolution, it sells all the naughty things that taste great but we best avoid. So it's in a taste area that we're trying to avoid, where people are more carb conscious, avoiding donuts, so on and so forth. So I think Retail Food Group at this stage will probably struggle for a while.
Okay, so a no to Retail Food Group. Would you be buying Retail Food Group at the moment, Gary?
It would be on the edge of my watch list. It would be on a post-it note, as I say, on the screen, just to keep an eye on it. But I wouldn't be buying it at this level. Okay,
so 2 no's for Retail Food Group. What about Flexi Group? FXL is the stock code. We'll start off with you, John.
Well, with Flexi Group, that's a stock that the clients at Redleaf Securities have done very well trading in and out of. Broadly speaking, at these levels, I'm quite comfortable picking up Flexi Group. As you're all well aware, Flexi Group is a leasing lending business that provides lending to the likes of JB Hi-Fi and Harvey Norman. Now, as we speak, you would have seen the retail numbers that came out recently, and they've been quite positive. So off the back of that, I'll be quite comfortable in increasing clients' position in Flexi Group.
Okay, so liking Flexi Group, I'm looking at...
I like it, yeah.
Oh, we've got 2 yeses.
So have a look in the weekly charts, a nice inverse head and shoulders pattern in there. It closed on its highs today. It's been an up day for the stock against our market, which was down 80-odd points. And we were talking about a moment ago, what are the warning signs at the top, which is the gap down? Well, this actually had the gap up about a week and a half ago, which hasn't been filled just as yet. So it's a good sign in the opposite direction, that when it sets a base and it starts to gap up, you know there's something cooking in there. But the weekly chart looks really, really good.
You know, it's always really nice when the fundamental analysts and the technical analysts, they're both saying the same thing. So not liking Retail Food Group, just having a look at the debt levels that Adrian was asking about. And debt is up a little higher because of those acquisitions. So in FY14, it was at $53 million. It's now up at $192 million. So that's a gearing level of about 33% for Retail Food Group. However, having said that, because cash flow is quite strong with Retail Food Group, interest cover is 7 times. So that's a very healthy amount. You'd be more worried about, I guess, the leverage a company has if interest cover was more at 2 or 3 times, but 11 times is over 10 and is very strong. Of course, if operating conditions deteriorate, that's when you'd get worried. But for the time being, Retail Food Group, despite its gearing level of 33%, it does look like, because of its strong operating cash flow, that it can cover those gearing levels. So I hope that helps you out, Adrian. And neither of our panellists liking Retail Food Group, but liking Flexi Group, FXL, the stock code there. We do need to go to a break, but we'll be back with more after this short break. So if you would like to speak with our expert panel, now's the time to give us a call on 1300 30 34 35, or you can always email us yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35. And of course, you can always email in yourmoney@skynews.com.au. And next, we've got one of our favourite callers on the line. Abe, Happy New Year.
Thank you. Happy New Year, Julia. I'd like to ask the panel a specific question about ResMed, which has been a laggard and traded in a tight band between $7 and $7.50. What is wrong with that stock? And General's question about, if you're holding the large energy and resources companies like Rio and BHP and Oil Search and WPL and Santos, would you be holding this and hoping that they'll come back, or would you cut your losses and go into something else?
Okay, so a question about some of the laggards on the market, and I guess it's been a pretty difficult year. There still would be a lot of investors either through the self-managed super funds or individually holding stocks in the energy space, in the materials space, and even the banking space. What do you do with these losses? I mean, I think there's a saying in the market, it's okay to sell when the market's falling as long as you do it quickly. But you've probably seen the majority of the losses now. So in a situation like this, I mean, Gary, what would you say?
I think you have. I think if you've held on this long, it's really now. I don't think it's going to happen in the short term, and I mean in the next 6 months. But we're starting to see a few signs of life in a few of the stocks, particularly in BHP, which I think is deeply oversold at these levels, and should really find its way back to $20 very quickly on this oil price and iron ore price settling down. But I think you've worn the brunt of it now. There's companies like Santos that haven't weathered this well. You've got to look inside. Jonathan might be able to help out with that. Look inside these companies, look at their debt levels. Santos is in a bit of trouble, whereas Woodside's still on the front foot, still out there opening up new fields and getting on with their business.
So Gary makes a good point that we've probably seen the bulk of the losses. So if you're looking to ride out the storm, probably some of the things that you want to look at is financial stability, so a relatively strong balance sheet to be able to ride out the storm. When you look at the energy and the material space, does it get you excited? Does it get you interested? Does the risk-reward profile, swing to more interest in this area in 2016?
Well, my biggest concern, Abe, is the opportunity cost of staying in there. Sure, they will recover, but you got to think of all the opportunities you're missing out on while you're waiting for it to recover. I believe resources is probably more of a 2017 recovery story as opposed to now. I can't really see an impetus out there which will make everyone flow their funds back into that particular sector. You have been through a lot of pain, Abe, with this particular sector, but if you were going to sell, just find the right opportunity to, as we speak. I think if you don't sell now, you're missing out on other opportunities, other more exciting sectors in the meantime.
Okay, so I see you both nodding your heads that perhaps this year's going to be another year of consolidation for that commodity space. But of course, that often means some pretty violent moves, both on the upside as well as the downside, Gary. So if you were looking to sell out of a position, is there going to be opportunities where we do see big rallies?
Oh, absolutely. We're at if you talk about seasonal parts of the market, this January, February is seasonally a good time of the year for some of the base metals, like copper. Copper rallied today after the sell-off on Monday. So it's and we'll see that. I think we'll see that through January into February, and it happened last year as well. We saw the resource stocks rally into January, February, but then along comes March and April, and we start to see the selling come back in, and then the sell in May and go away. Really seem to hit the resource stocks pretty hard in the year just finished. So I would like to think we're going to see a repeat of that. I'd be looking for that in the market. I'd be looking for an opportunity to lock in profits. If you're buying these stocks, and particularly if you're speculating on trading these stocks up and down, don't fall in love with them. Just trade out of them and
okay, so lots of trading opportunities this year, and perhaps more of an investment opportunity in 2017 for the energy, the material stocks. But I mean, what kind of things are you looking for before you get into companies like this, John? I mean, because in my mind, a lot of things in life are cyclical. Things move in cycles, and we're obviously in a down cycle for commodities at the moment. But if we do see it turning, so many people are underweight in this area that it could be quite a quick move upwards.
Well, the first place you'll have to look at is obviously at the balance sheet. If we're looking at the energy sector, there was a report mid last year which clearly showed that Woodside Petroleum had by far the strongest balance sheet amongst pretty much the whole world in the whole energy sector, not just within Australia. So balance sheet is paramount if you're looking at that particular sector. The other thing that I will mention about the energy sector, you would see investment bankers licking their lips in terms of merger and acquisition activity in this particular sector. Some will see, some that will probably turn out later towards the year. When a sector's been absolutely demolished like the energy sector has, it just gives it a prime opportunity for merger and acquisitions to occur.
Okay, so look out for some M&A activity. I know we have Matthew waiting on the line, but I do want to touch on ResMed. So we might come back to Matthew after the break, and let's talk about ResMed now, because it has been a rocky ride for ResMed. Just have a look at that share price on your screen there. You know, at the beginning of last year, it was pretty close to $10, and now we're seeing it having recovered a little bit at $7.29. So looking at sleep apnea, people who have trouble breathing when they're asleep, traditionally, you know, a very strong market. In fact, profits have been rising here, but the reason why we've seen ResMed share price coming under pressure is because one of the studies it had, and you know, the thinking had been that sleeping well helps to prevent heart conditions and from dying prematurely. But in fact, this study actually found the opposite, and we saw ResMed's share price falling quite substantially. Having said that, it has recovered off the lows, and the low last year was $6.69. Gary, just having a look at ResMed share price, are you a little bit more positive on ResMed for 2016?
Not really, no.
No.
Not on the chart that we're looking at. In this weekly chart that we've got here, if you drew a line underneath those three lows in there, if it trades down through those three lows, it's essentially all it's done is rally half of what it came off from its highs out of $10. And it's recovered half of that value, which is a technical, high probability technical thing. When prices come off dramatically, you generally see a 50% retracement. If it fails to trade above that 50% retracement and fails again, which this stock has, back to its lows, and then if we break down below this $7 area, I think it's on for another leg down, probably into 570, 580.
Okay, so if you're in ResMed, I guess Gary's message would be to have your stop losses in place, because around that $7 area is an important technical test for ResMed shares. But of course, the flip side is if it bounces off that level, hopefully that sort of smallish uptrend continues. But he's saying the probability is that it might be a break to the downside.
Struggling. The way the trend is, it's actually struggling to go up. Because it has a run and has a significant pullback in that movement up, and it pulls back almost 100% of that short move up. So it can become quite a struggle, and ultimately it'll pick up buyers along the way. But if it breaks those lows, then everyone's in a losing position. You'll see the stops get hit very quickly.
Also, at a critical juncture, technically, just quickly on ResMed, would you be buying or selling, John?
I'd be holding at this stage. I wouldn't be adding to my position, nor would I be selling it right now. The fundamentals behind the story are quite positive in that sector.
And would you choose to get access to the sleep apnea story perhaps through Fisher & Paykel instead, or do you prefer ResMed?
Given the price of ResMed, I'd probably prefer ResMed right now.
Okay, so preferring ResMed, and how about you, Gary?
Fisher & Paykel's actually doing a little better chart-wise, but I would, if you're a holder of this, I would agree. If you're a holder of this, they're a global company. They have lots of opportunity in front of them, and I think that it would be a holder best in a portfolio.
Okay, so that was ResMed, and we'll be back with more after this short break. If you'd like to speak with our expert panel, the number to call is 1300 30 34 35. Stay with us. Welcome back to Your Money, Your Call. You're watching our special 2-hour holiday special, and we'll be here for another hour and a half answering your questions. So please give us a call on 1300 30 34 35, or you can send an email to yourmoney@skynews.com.au. And on the panel with us tonight, we're very lucky to have John Athanasiou from Redleaf Securities, and also Gary Burton from FP Markets, and of course I'm Julia Lee from Bell Direct. And we do have our next caller on the line, so let's go straight to Matthew. Matthew, thanks for waiting. How can we help you out today?
Hi guys, my question today is about Australian Agricultural Company and whether the panel sees there any long-term value in the stock, and could it benefit at all from China like your Blackmores or your A2 milk? I was just wondering about that.
Sure, it's a good question coming through from Matthew, and probably something that a lot of people are wondering. You know, we've seen a lot of these food type companies doing quite well, in particular Bellamy's, Blackmores, Capilano, Honey. A company like Australian Agricultural Co., would you class it in the same boat? Looking at the share price, it hasn't been performing as well. And I guess, in my mind, if I can kick it off, when you strip away the actual brand and the marketing, what you're left with is a commodity. and a commodity isn't as valuable as a brand like Bellamy's, which is selling that organic Australia feel-good, safe food. So when I look at Australian Agriculture Co, yes, it's attractive because cattle prices, near those record highs, and they've been quite high. But on the other hand, to me, unless there's an extra brand out there, like, maybe King Island beef or something like something special that makes people want to pay a premium, then to me it's just a commodity-based stock. Looking at the share price though, Gary, cattle prices still very high. What's the go with Australian agriculture?
I'm a bit of a fan of the agricultural sector overall, and Australian agriculture, you can see it's struggled share price wise. It's been everywhere recently, from $1.25 to $1.50, and it's back here at $1.33. They're involved with the very large abattoir they're building up in Darwin for direct export into the Asia area, and so there's a lot of work to do for the company yet before they see any real figures on the table. They're holding. They recently came out and upgraded themselves in their forward guidance back in October, I think, last year, and really the price hasn't reflected that. So they're a long-term story. I agree. It's they haven't got the numbers yet on the table. We're in the agriculture area. What I like about the agriculture area at the moment is, as you mentioned, Julie, we've got beef cattle prices at highs. We've got sheep prices at trading at very high prices. We've had a reasonably good wheat crop this year. We've got agricultural land trading at a premium at the moment as the investors come in, and so we're seeing some real interest in this Australian agriculture area, and I think it will be the theme, a little bit of a theme through 2016.
Okay, and the share price just languishing because they're not paying that interim dividend. They're reinvesting, as you mentioned, in building that abattoir.
Yes, yep. So they're out there, doing what they do, but it still requires, good seasons to follow through, and they have to produce numbers, and that's where we're seeing the share price really consolidate around.
Okay, but from a technical viewpoint?
I think it's basically a hold. I don't know if you'd rush out and really buy it at these levels, but it's basically, if you've got it, you'd hold it and see what comes of it. If it breaks down through $1.25, I think it's over.
Okay. I love my steaks, John, and if you've ever travelled throughout Asia, Australian steaks are especially expensive because of the quality. I remember paying $50 for a steak in Japan, which was half the size that you get at my local pub. So Australian beef is recognised as high quality. Australian Agricultural Co, is it in a good place to, cash in on that China story?
Well, we all love a good steak. Particularly one that goes down with a Lake George bottle of wine. With Australian Agricultural Company, you're playing the soft commodity game, and I'm a believer that soft commodities will keep on going forward because of that demand from China. You're right, Julia, that it doesn't really have a brand attached to it, but if you're a believer that soft commodity prices will go up, I think it's a good way to get exposure to that space.
Okay, so a very interesting company because it is vertically integrated. So basically from the cacao all the way to the export market, it looks after the whole lot. I noticed that Bell Potter's just recently put out a note on it as well, saying the perfect cut, and they have a price target of $1.62 on it. So, they've got a buy rating, and that's just initiating that initial call into Australian Agricultural Co, which deals with cattle. Let's go to our next call. I've got Ben now on the line from Brisbane. Ben, welcome to the show. How can we help you out?
Hi, thanks, Julia. Just calling about Transaction Solutions. They're installing ATM machines in India. They've got 100 million transactions a year currently. There's been some big hitters join the register. I'm just wondering if Gary could give me a technical, please. Sure.
We might just look at a technical view because I know, John, that you own the stock and Red Leaf did the capital raising. The share price has been going well. They've just done a capital raising. TSN's a stock code, very small, $33 million market cap. But Gary, just when you do see charts like this, how do you trade them and what do you think?
It is very small, and you need to take a sizable position to get any leverage out of price movement on this. And one of the issues with this is the volatility in these small stocks. So you've kind of got a situation where you really don't want to hold a big position. It traded about 7.9 million shares today, and you really can't hold a position too big that won't allow you to exit quickly if you need to go to the door. But it has had a very strong move. It looks very good technically. Nice strong base technically on the weekly chart, and a breakout above its recent highs. So it's technically it looks great. It's this would be if you buy the story, if you look into the story and you're buying the story, yeah, it'd be a good one to have a look at.
Okay, so looking pretty good. That's TSN is the stock code there. We'll go to our next caller. We've got Darren on the line from Perth. Darren, welcome to the program. How can we help you out?
Hi, Julia and panel, and Happy New Year to all.
Happy New Year.
A couple of stocks. One's Orocobre, ORE, which has the lithium mine in Argentina, and the last announcement said something about going positive on cash flow. The second stock is Saracen, which is in gold. Looks like it's got a pretty good chart so far. And I noticed that gold did tick up a little bit overnight with the issue in the Middle East, so a bit of a conversation about that would be great.
Absolutely. So two very interesting stocks. Let's start off with Orocobre. ORE is the stock code there. I mean, a lot of people have been big fans of Orocobre for a while, even though it is a relatively small company. That lithium area seems to be powering along well. I hold SYR, SYR is the stock code there, and that's been performing quite well as well lately. So is lithium going to be, at least one of those commodities that performs well in 2016? But let's start off by looking at Orocobre's share price. ORE is the stock code. We'll start off with
it actually looks quite good in the short term. It's had a very strong move in the last few weeks, but it has made a significant low down at around $1.40 and simply traded vertically out of there, and that really makes me quite nervous. You can see a lot of very quick profit taking. You can draw a line across the top of the chart now. It's got at a resistance level. The line slopes down a little bit. It is at a resistance level around $2.60. If it consolidates here and makes another move, it would interest me greatly.
Okay, and looking at that lithium space, what are your thoughts, John?
It is one of the few commodities out there that will perform well, given that it's particular niche. But in relation to this particular stock, I would be quite cautious in picking some up at these levels. I'll just wait for it to pull back a little bit before I'd put a small amount in.
And if you're holding it, I guess enjoy the ride.
Absolutely.
Absolutely. And Saracen, gold's at an interesting juncture. We finally saw an upward movement in gold overnight. I guess the global volatility that we've been seeing has seen some safe haven flow into gold prices. So I guess, firstly, looking at Saracen, would you be buying into Saracen? I think the stock's reaching a year high. That stock chart looking very good.
Yep.
Is this one you like?
Saracen up there with Northern Star, probably the two best gold stocks out there. My only concern is in the gold sector broadly. I'm concerned that the US dollar will appreciate quite significantly, so funds will flow towards the greenback as opposed to the bullion. Australian gold companies have been doing quite well because of the weakness in the Aussie dollar, but overall I'll probably be avoiding that space.
Okay, so avoiding gold. I mean, Gary, I'd be interested to get your thoughts not only on Saracen first, but also on the underlying gold price. What are your thoughts?
Yeah, I think there's a base coming in gold above $1,000. We saw it trade down to $1,046 in its lows, and it's starting to consolidate at these levels, which is really good. And within this gold sector in Australia, we've got several small companies that don't carry a lot of debt, Saracen, St Barbara, Regis Resources, all trending up, all in a primary uptrend along the way. Newcrest is doing a little bit tougher in this area, but the smaller players are doing quite well. Again, there's a number of them aren't doing well in the space, but Saracen is one of them. Saracen broke out this week, another 52-week high on the stock, and looks really great, actually.
Okay, so liking Saracen, and sounds like liking gold in 2016 as well, Gary.
I wait and see on that one. $1,000 is going to be a very, very strong support level. It was the original breakout level 10 years ago, and it really does need to hold. So if it builds a base along there, I think it'll fare well for 2016-17.
Okay, so that was Orocobre, ORE is the stock code there, and Saracen Minerals, SAR is the stock code there. We do have an email here. We've got one here from Alan who asks, I'm currently holding shares in Crown Resorts and they've given a small profit. With the talk of privatising Crown, should I hold on and wait for an offer, or does the panel think it would be better to get out now? Good question coming through from Alan, and we might go to John first on this one. Crown, would you stay or would you go?
I'll be staying, and just to see if all those speculation about being privatised actually pans out. Definitely something must be cooking with young Jamie pulling out of the board. We just don't really know what that is. So I'll be waiting out to see what occurs. Okay,
so waiting it out. I mean, Gary, would you be taking profits here or waiting?
No, I think I'd be waiting it out as well. You'd be buying the privatisation story. Behind the scenes, Crown is still under a bit of pressure in Macau and Las Vegas, but with the Las Vegas story, I was reading just a couple of days ago, the Barangaroo project is slightly behind schedule and not a great deal, but to be worrisome, but it is behind schedule at the moment. So you're buying the story on this. It is a hold. There's no need to sell, and there's really no need to add to it either.
Okay, if anyone's not in Crown and interested in this story, would you be saying buy, John?
I would definitely be picking up a little bit up at these levels. I think there might be some element of truth behind the privatisation story. And just wait and see, yeah.
And I suppose if you're unsure, you could always put a stop loss in there as well.
Absolutely.
So Gary, would you be picking up a little bit here too?
Yeah, it's paying a dividend. It pays about 30 to 40 cents in dividends, and yes, if you were really keen on the story, yes, you would be a buyer at these levels. If you hold it, you just hold it.
Okay, so the long-term story, I guess, remains intact if we do see a recovery in terms of the China story, less of a crackdown in terms of the corrupt officials and more spending, hopefully, at those Macau casinos. We do need to go to a short break, but if you have a question you'd like to ask, please give us a call. We'd love to hear from you. The number's 1300 30 34 35, or you can always send an email to yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35 and your emails on yourmoney@skynews.com.au. And we have our next caller on the line. We've got Julianne from Sydney. Julianne, welcome to the show. How can we help you out?
Yes, hi guys. Look, I'm interested in buying back into Sonic. The reason being is that it's come off from a high. The fundamental model is still fairly sound. Obviously, the federal government's capped the rebate, but the fact is, I would have thought GPs are still going to use the services, so the co-payment will pick up the slack. The global business model, you'd have to think there's some upside there, but the charts do look weak. So I'm just wondering what the panel think about the outlook and how low can it go?
Sure. So a lot of pain for a couple of stocks on the market just because of changes to how the federal government wants to spend its money in terms of healthcare, and that's been Sonic Healthcare. If we can bring up a stock chart for Sonic Healthcare, and the other one's Primary Healthcare as well. It's difficult because this is probably a trend that's going to continue in Australia. As we have an ageing population, the government's not going to be able to spend as much. So we're probably going to see government spending in this area being pulled back, and given that the government is the largest payer of the bills for companies like Sonic Healthcare and Primary Healthcare, we've seen the stock prices taking a big hit. Is this an opportunity or is it time to be cautious? We might start off with Gary because Julianne's asked for a technical view on this one. So firstly, just having a look at the charts, and are you bullish or bearish on this one, Gary?
I'd be very bearish on this from a chart perspective. And this, at the top of the show, we're talking about what you would look for in a reversal pattern. And Sonic Healthcare's got it right at the top. There's a big gap in the weekly chart, a big price gap around $22, which wasn't filled. And we saw in November it's actually formed a lower high during November and is starting to break into new lows. So $17 is the next support level on this. It's currently around $17.40. The whole pattern is a reversal head and shoulders pattern in the stock. There are areas in the healthcare sector like Sonic and like Capital Health and some of these players that have really been knocked around And that was, if there was anything to take out of 2015, is don't stand up against government government legislation and private equity. That've been the two real sore points of 2015. And this is another one. If this breaks down from here, then it's simply you'd be buying it down at $15 and $14.
Okay, and I guess the government being the biggest payer of bills for Sonic Healthcare and primary healthcare, this has a big impact. I mean, in terms of earnings, it will probably be an impact of 5 to 6% next financial year. But in terms of the business model, you'd have to ask whether we are going to see collection points closing down and how these companies are going to deal with sort of the new world. Opportunity or more risk out there?
I would say best avoided, Julia. You know, one of the lessons of 2015, as was just recently mentioned, was to avoid stocks or sectors that, you know, require some government funding. The government has actually looked foolish in terms of funding, you know, the childcare sector where there's been rorts, and particularly in the educational and training areas. So I don't want to, the government doesn't want to, you know, get caught with its pants down, so to speak, and it needs to manage that deficit that's out of control as we speak. So I would definitely be avoiding that particular sector. Okay,
even though, you know, people, if they need medical imaging, probably will continue, the majority of people continue to pay for it because it's one of those areas with an ageing population. I'd imagine that the demand for these type of services would also increase.
Correct, but it's just that sentiment against anything that's associated with the government, and you don't want to fight against the flow of money, which is pulling out of that area. Okay,
so too early to jump into the stock. Gary thinks this is reversal market.
The market's telling you this is going lower.
And this is going lower. So looks really interesting here, Julianne, especially in that healthcare space, which does tend to be, I guess, a stable area that tends to have rather stable cash flows in bad and good economic conditions. But given the uncertainty here, I guess the market is punishing Sonic and Primary, and Gary saying, look, this is probably the start rather than the end of its pain.
I think, yeah, if it breaks from here, certainly. And the opposite side to this, if it does find support here, you really don't want to be the risk of an early adopter here. You really want it to show you that this is going to work for you by you when you put your money in there. So it's really time for these patterns to really take hold, and that's where the high probability trading occurs.
Okay, so you want probability and you want strength on your side. I hope that helps you out a little bit, Julianne. We have our next caller on the line, so let's now go to Tom from Lake Macquarie. Tom, welcome to the show. How can we help you?
Yes, hello, Julia. I have a question about a company called Norwood Systems.
Sure.
Code NOR. It has a mobile phone app called World Phone, which has been really doing well in download numbers. I believe it's getting close to 2 million downloads. It's sort of aimed at the global roaming bill shock phenomenon. And just wondering what Gary thinks from a technical point of view.
Sure. So, Tom, do you hold this stock, or you're looking at getting into
No, I have held it. I've sold it. I've held it.
Okay, so trading this.
Now I hold it again.
Yeah.
Okay, and I think John's been doing the same and has been doing quite well out of this smaller stock. About $70 million market cap, so not a massive stock. It recently had a capital raising, I believe, but the stock's been trading about 10.5 cents at the moment. It has been volatile. It's been as high as 16.5 cents over the last couple of months and as low as 5.6 cents. So lots of volatility in there. Gary, just starting off with a technical level before we go to John for a little bit more on the fundamentals.
Yeah, it's starting. It looks like it's starting to find its feet from a chart perspective here, because when you look a little closer into the price action, you'll see that the rallies are done on significant volume, and the consolidation areas is where it trades sideways and pulls back a little bit is actually done on much less volume. So the buyers are in there, and it's a buy and hold at this stage. As you mentioned, Julia, it did set a low at around 5.6 cents a short time ago. It is starting to break higher now. It's at a short-term resistance level around 10. Needs to trade over this to really give you some comfort that it will trade trade back out over 14 cents and make a new high. I'd be very interested in this. It's really good.
Okay, so nice setup technically. I mean, John, what got you interested in this company? Because you've been in and out as well.
What got me interested in this company, Tom, is when I met the CEO of the company and I actually downloaded the World Phone app. It's quite an impressive app. So how the app works, it's a Wi-Fi to landline app. So when you call someone on WhatsApp, you realise the quality of the phone call is not that great because it's Wi-Fi to Wi-Fi. What Norwood has done is managed to have agreements in 75 countries with companies similar to Telstra to have that landline access. So when you call someone overseas, it's like calling landline to landline. And the other source of revenue for Norwood is you could actually buy numbers overseas. And and you pay on a monthly basis. So you could be travelling to Brazil or to any one of these 75 countries in order to have your own SIM. So in order to have your own number and avoid getting a SIM. Okay. So this is perfect for business travelers. I've done quite well on this stock, trading in and out of it. I find it quite difficult to trade now. I'll probably wait for it to settle down a bit and keep on monitoring their download numbers. Another stock you should be looking at, Tom, that does the same thing is FlexiRoam. I believe the code is FRX. It is a micro cap. I believe the market capitalisation is roughly 20 mil, so you got to have that risk appetite if you want to look in that space. But FlexiRoam pretty much does the same thing, but targeting the Asian market more particularly. So they've got an alliance with Malaysia Airways.
And that was my other question. I mean, what about competition in this area? These are relatively small players in this field. It seems like a relatively easy idea to replicate.
It's actually much harder than it sounds. The reason why they have superior technology as we speak. So if you come up with the idea of World Phone, you kind of want the Apples or the Microsoft of this world to take you over. So when you actually use it, it feels like you're making a normal phone call that you are on your iPhone 6.
So you basically need Wi-Fi to be able to use the technology, but you can have an international telephone number, so if you're travelling for a month, then...
And you think about all of the business travellers out there, it's phenomenal. The majority of their revenue or their clients happen to be in the Middle East. So Dubai, for example, a lot of international workers.
Okay, so you bought in at 3 cents and you sold at about 8 cents.
8, 9.
What type of levels would you be interested in? Perhaps
it's just, well, we'll have to speak to the technical guy, but it just looks very difficult to trade right now. I'll probably be waiting till around the 6, 7 cents mark to get back in and do more homework on FlexiRoam.
Okay. And Gary?
Well, it is, I mentioned it is at a really short-term resistance level here at 10 cents, so it needs to trade back over there. If it pulls back to 6, that would be great, and found a bit of support there, and moved again on volume. It needs to move on volume, which is what it's done, which is a terrific pattern. The other one, FlexiRoam, volumes are quite light on that. It's traded about 13,000 today, so that's not a stock you'd really want to hold a big position in. But that also looks like it's starting to get a bit of liquidity in there as well from earlier.
I think you'll see more people that have made money from Norwood will shift their funds into this little speculative FlexiRoam.
Okay, so we're looking at the very small space, so you do need to have the risk appetite and, of course, understand the liquidity behind trading some of these positions. But NOR's the stock code there. Gary saying that, you know, the technicals look pretty interesting there, and John's been in and out and perhaps might be looking to get back in again. We'll be back with more after this short break, but if you'd like to speak with our expert panel, our number's 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to the program. I'm Julia Lee from Bell Direct, and joining me on the panel tonight we have John Athanasiou from Redleaf Securities and also Gary Burton from FP Markets. And if you have a question you'd like answered, we'd love to hear from you. The number's on your screen, 1300 30 34 35, or you can always email us yourmoney@skynews.com.au. And we now have Doug on the line from New South Wales. Doug, welcome to the show.
Yes, thanks, Julia. Look, I'm pulling out my third choice here, actually. My first choice was Norwood Systems, but I got beaten to the punch. I certainly hope it doesn't retrace to 7. I breathed a sigh of relief today when it closed above my average price. I hold a few 100,000, so hoping it can keep going. The question I'm going to ask is on Bartercard, BPS. I've looked at it, I've bought into it, and I don't fully understand it, but the financials look okay, and I just thought I'd like to get an idea. And there was a second stock I did mention to the lady, but she couldn't find it on her list, and I thought it might be one you would have come across, Julia. It's TTC, Traditional Therapy Clinics. They franchise clinics in China for traditional Chinese medicine, and financially it looks very good. So I've been interested to hear anybody's comments on Bartercard especially. Thank you.
Let's talk about Bartercard. Actually, Doug, when you said Bartercard, I thought, are they still around? It seemed to be the 1980s when Bartercard was relatively popular until the tax office cracked down and said even if you're bartering services, you still have to pay tax on those services to sort of the cash value. But I imagine that Bartercard BPS technology, BPS, is a little bit different in its modern form. We might start off by having a look at the stock price. So BPS, Gary?
BPS around $1.16. It found a low just over $1 a few days ago, about a week ago, of $1.05. A very thin volume on this stock. It's only traded 5,400 today. That makes it wouldn't come up on my radar as something to look at. If you want to take a small position, believe in the company, then yes, by all means, the trend looks actually pretty good. It's starting to get a little bit of nice support area around $1.05, and resistance currently is at $1.30. And if it breaks over this recent little short-term high here at $1.20, then I think it'll be off to have another look at $1.30. Okay,
so Bartercard looking like an interesting proposition from where they used to be in the 1980s, so more of a business payments company now. Still very small market cap, $67 million, but P ratio of just 8.6, dividend yield of about 4.7%. So fundamentals looking good as long as they can continue at the pace they have been. What do you think, John?
The fundamentals do look good. Doug, I'll have to do a bit more homework on the fundamentals of the actual business structure of BPS, but if you're looking at those kind of numbers, it does give you some level of confidence that it has a very positive future. I would only put a small amount in there, given that it's a micro cap.
Okay, so
and a low volume.
Bartercard's been around for a long time, but I think it's only been on the stock exchange since 2014, so not a huge amount of history on it. And it still has that Bartercard business where you're exchanging services, but also payments area as well that it works with, and also a trade exchange software services, which is a software platform which was developed to service Bartercard's trade exchange. So it'd be interesting to go back and look at the 2014 prospectus, what they're forecasting in terms of growth. They've just done a capital raising for $5 million, and just having a look at those technicals that Gary mentioned, and the fundamentals looking quite interesting. So we probably have to dig a little bit deeper there. So I'll definitely be doing that one tomorrow. So thanks for that call, Doug. Let's go to our next caller. We have Aaron on the line from the Hunter Valley. Aaron, welcome to the show.
Hi, Julia. Thanks for taking my call.
You're welcome.
Really, I'm just really interested to get a technical perspective on Unilife. It's a drug delivery company. They've just announced a partnership with Amgen, and I just wanted to ask Gary, like, they normally, volume's normally about 1 million shares. To the last 2 days, it's sort of averaged about 33 million. I was just wondering if he thinks it might be a good time to buy this stock. Thank you.
I had a look at this stock yesterday because I remember this stock as a retractable needle, and they do delivery systems for drugs to make it more efficient. And this used to be a very popular company. Just having a look at the highest price that the stock price has traded at is $1.78, which was back in 2010. But, the lowest price has been sort of 10.5 cents, which was recently, the 29th of December. But now the stock's at 24 cents. In fact, yesterday, I think the stock was up more than 200%. Yeah. So lots happening. It has signed an exclusivity agreement with a US company. So that's been a massive positive, and that's driven volumes and the share price rise in this area. But it's been such a bumpy ride. I mean, you look at the long-term picture. Yes, the short-term picture, we've seen a little bit of excitement coming in there. But this is a stock that used to trade at $1.78, not 10 cents, and now 24 cents. But Gary, when you do see a massive spike up like this,
have no interest in that at all. It's the high. If you look at the weekly chart, the high of the spike at 40 cents this week was the low period set during August 2014. So all it's done is really come up and tested the breakdown area where it broke down. The stock price broke down below 40 cents during August 2015, broke from 40 cents down to down below 13 cents, and all it's done is really come up and tested that area. The sellers were there straight away, and it's been marked down to 24 cents in a very quick time. So volatility is very high. This is really of no interest in as far as it becomes difficult to trade because you can hold positions and have it move against you 20 and 30% in a day, and if you're not ready for that type of price action, it can be quite hurtful.
Okay, so a no from Gary, who's a specialist in terms of technicals and the charts. Yep. I mean, looking at this one, John, you know, the story was such a good one back in 2010. They've had the technology for a while, as well as some other technologies. So I think there's also things to help with insulin for diabetics that you can wear, a wearable machine that can give you doses of insulin and things like that, the retractable needle, different delivery systems for drugs where, you know, the drug's are already in the needle, so it's ready to go. And yet, you know, it's still having a difficult time making a profit. And, you know, while the share price was up more than 200% yesterday, you know, today it was down 35%.
You'd expect that after a day where it's jumped 200%. The problem I have with this, Aaron, is they've just got that agreement, which is great news, phenomenal. But you got to think to yourself, who has the power in this relationship? I suspect it's not Unilife. So what if, you got to think about the risk, what about if there's a clause where that agreement could fall apart? So off the back of one agreement, I would not be investing in a company.
Okay, so that sounds like a no from John and a no from Gary as well. Let's go to our next caller. We've got John on the line from Victoria. John, welcome to the show. How can we help you out?
Hi, thanks for taking my call. Looks got a question about AdSlot, ADJ.
Sure.
It's like a sort of like an online, or sorry, like a trading platform for digital media. I'm trying to I probably want to get a TA perspective on it for sort of entry price. Over the last couple of days, it sort of shot up about 10-15%.
Sure.
Is this a good time to buy, or should I hold off for a bit, or what do you think?
Okay, so Gary, just having a look at marketing, especially the online advertising market.
Yeah.
And what do you make of
this week's movement has actually pushed it into a primary uptrend. It's broken the recent downtrend. So support around 9.9 cents in there, and it's traded out today, closed at its high at 10.5. Looks very, very good. Let's see where this trades in the next few days. If it consolidates and holds up these prices above 10 cents, then it'd be a great place to enter, I think, as a short-term trade. But it's a nice base behind it over a couple of months, and looks very, very good.
Okay, so looking good. I mean, more and more of advertising budgets are moving away from television onto the online market. So it's certainly an expanding area. Having a look at a smaller company like AdSlot, which I guess looks at the trading and the automating it.
Yeah.
What do you think, John?
I'd be watching, put this on your list to watch, John. I wouldn't be jumping in right now. Just wait for the stock to like plateau a bit. It's been quite volatile, and then you know, then dip in when you think it's more stable.
Okay, so I guess at this point, anyone sort of joining up with AdSlot is probably an early adopter, and you have to wait to see whether there's going to be sort of a mass
Absolutely.
attraction there to AdSlot. But an interesting concept, ADJ is the stock code there. It is now time for an email. We've got one here from Bo, who asks, I've been looking closely at Wesfarmers. Does the panel think that it's a good buy, or should I be looking elsewhere in that sector? It's a real shame for Wesfarmers because it's been weighed down by what's happened with Woolworths over the past year. Looking at Wesfarmers and Woolworths, would you be entering into either of those companies, which are massive companies in the consumer staples space, or would you be shopping elsewhere, John?
Well, you know, Wesfarmers is such a great company. You see how well Coles has done, and you know, during this Christmas period, how busy was Bunnings? I mean, they just keep on getting people going in there consistently, as opposed to Woolworths' Masters. In terms of value proposition, though, you probably have to favour Woolworths, surely they'll eventually be able to get their act together and turn, that major enterprise around. So I'd probably be favouring Woolworths right now over Wesfarmers if I was in that space.
Okay, so favouring Woolworths. How about you, Gary, looking at the technicals for both of these companies?
Yeah. I sort of take a different view. Woolworths is interesting. With this Chinese portal they've recently opened or starting to set up now, that might be the turning point for Woolworths in there, so we need to wait and see on that. I think Wesfarmers is much more interesting. It's that resistance level at the moment is around $42. It has a double bottom in there in the daily chart around $38. If it breaks above this $42 level in these coming weeks, I think it'll be having another look at around $45 to $46 very quickly.
Okay, so looking pretty interesting for the supermarkets. Certainly very big. And I noticed that IGA or Metcash, MTS, has also been doing relatively well lately.
I think that's a great turnaround story.
That's another company that's opened up that portal over in China, hoping to get some Australian products out there. Looking at the three of them, which would be your pick, Gary?
MTS as a turnaround story, Wesfarmers as a portfolio, and Woolworths wait and see.
Okay, and how about you, John?
I would have to favour Woolies or Wesfarmers and Metcash. The reason why I'm very concerned about Metcash, it's nearly one of the top shorted companies if you go on that shortman.com.au.
Yes, it is.
Yeah, and that's why Gary would be positive, because if there's positive news, you see a violent reaction.
The shorters.
If they get caught if the shorts get caught on the wrong side of this, it'll recover very quickly.
Okay, so nice to see some differences of opinions there. Looking at the consumer staples space, which has been a hard one over the past year, but perhaps a few more opportunities in the current year. We are going to take a short break, but we'll be back to answer more of your questions in just a moment. If you'd like to speak with our expert panel, the number's 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to the show. If you have a question you'd like answered, please pick up the phone and give us a call. The number is 1300 30 34 35, or you can email us on yourmoney@skynews.com.au. And we do have our next caller on the line, so let's go straight to John from Victoria. John, welcome to the show. How can we help you out? Hello?
Yes, Julia, thank you for taking my call. I just wanted to ask a question. There's a little company that I've been looking at called CZL, Consolidated Zinc Limited.
Yes.
Over the last 12 months, I've got a lot of, my share portfolio has a lot of blue chip shares, and the majority of the top 200 shares have all taken a dive over the last 12 months. And my broker is asking me to start looking at some of these little speculative shares that might have a little bit of a gain. This company has a very high-grade zinc mine in Mexico that they hope to get into production later this year. And I'd just like to get some advice from the panel on what they think, whether they think I should buy or not.
Sure. So having a look at Consolidated Zinc, very small, $12 million market cap in that commodity space. I mean, the first thing I'd say, John, is that it's probably more of a little bit of a punt on the side rather than a core holding in your portfolio or longer-term portfolio. Certainly not something that I'd hold significantly in my own portfolio, being the size that it is, and certainly not in the self-managed super fund, given the space it's in, which is zinc, which is used a lot in alloys, so very much tied to the China story, steel production and things like that. But in terms of just having a small play with Consolidated Zinc, I think that's a different question and something that we probably can discuss. So, John, anything that you say to John in terms of looking in that small space versus the large space? Yes, the returns have been there, but one of the things that I notice is I love the small and the mid-cap space. I mean, I like to play in that area. I like to, make a few punts in that area, but having a look at the valuation of the small and the mid-cap index as well, it's traditionally at the sort of peaks before it tends to come back again. And some of the valuations are starting to get quite heated. And certainly there's a lot more interest in that small and that mid-cap index because, the ASX 200 index hasn't been powering along, especially the top 20 blue chips. But long term, is that a sustainable strategy? And what about putting some of your money in Consolidated Zinc?
Well, in relation to Consolidated Zinc, one positive aspect, and bear in mind, you got to have that risk appetite. It's a small junior resource exploration company. The key element here is the fact that they recently completed a capital raising, which was quite successful and it's trading well above that. So if you do have that risk appetite, it's probably one of the better ones. You should be reassured if a company is able to easily raise equity, because obviously it means the people that are really behind it support the story, John.
Okay, I mean, very small company, $12 million market cap, which means you can't really put too much money in it because it's not going to trade that much on a daily basis. But looking at the zinc players, I guess Oz Mineral comes to mind. It's the second largest, I think, producer of zinc in the world, and then a small company like Consolidated Zinc. So, Gary, looking at some of these smaller players, and I guess you have to be intimately aware of what the company does and the prospects of the company.
Yes, I kind of tend to divide these companies into two groups. Those that are out there scratching around, looking through their tenement, and the other ones that are actually producing something. And these guys, they've got leases. They've also got a uranium lease in Western Australia. A little bit of interest in uranium again at the moment. But technically, they were relisted a short time ago. They're starting to get a little bit of volume in the stock now on a daily basis. Today it broke out to a new high at just over 6 cents. So as a speculative play, yes, it looks very, very interesting at these levels. Keeping in mind that zinc, with the other rest of the base metals, is really doing poorly on a global scale at the moment until we see a real sentiment change in that area.
Okay, I mean, the only thing I'd say is just be very careful. Like in the last couple of months, the lowest volume that I've seen is around about just under $3,000. So the whole day traded, and it only traded $3,000 worth of stock. So if you're looking at a trading position, can be difficult to get in and out of. And then the most it's traded in the last couple of months that I can see is about $430,000. So you're looking at extremely small positioning sizes there, I think, for Consolidated Zinc, unless you want to move the stock price and have it go through the stratosphere. But it has just done a capital raising, as John mentioned, of $3.5 million, and I guess it's just about having intimate knowledge. But I would class this more as a specky play rather than a core holding in the portfolio. Let's now go to an email. We've got one here from Ben, who asks, after hearing the ongoing speculation in regards to the price of NAB, does the panel think I should hold on to my shares and ride it through as I'm interested in the long term, or should I sell and look to invest in a different area? John, looking at NAB, you know, we've got the Clydesdale IPO happening soon. Would you be holding on or would you be selling?
I would be holding on. There's not many places where you'll get that kind of yield. Last year, all the big four completed their equity raisings to meet with their APRA requirements. I don't anticipate any of the banks needing to raise money again. So parking your funds in NAB and leaving them there seems to be a wise decision. I don't expect NAB or any other three banks to shoot the lights out, but I think it's a good conservative investment to have for this year.
Okay, so liking it, and Gary nodding his head, liking these levels.
I think so as well. There was and I can't think of the name now, someone else did a similar share, bit of a split with one share offered for every, National Bank will do that, they'll offer one share for every NAB share that you hold. And that share, that once they broke that company away, and it was in the UK as well, they did quite well. And so they're expecting this this Clydesdale deal to do quite well once it's moved away from NAB management. So at NAB at the moment, we've seen, just on that, we've seen a significant low set in the market on December the 15th. NAB was one of them. I think the banks are a hold at any level through here. And the previous caller mentioned that his blue chips hadn't performed quite well. Well, he has actually received anywhere between 6 and 8% dividend return throughout the year. So they've remained, from that perspective, they've remained positive through 2015. I think they will do the same in 2016.
Okay, so NAB, you know, we're looking at the demerger of its UK assets, the Clydesdale IPO, which will happen in around about February. And realistically, just having a look at its business model, I guess it's coming towards the end of its strategic turnaround. So hopefully that starts to pay dividends for shareholders. I guess the banking space has been a hard place to invest in 2015. Looking at the banks, John, and are you more positive in 2016 or are you cautious on an individual stock basis?
I'm more positive in 2016. They've done and dusted their raising, they've secured their balance sheet, so all of the big four are looking pretty good. If you had a preference, you'd be looking at ones that have less exposure to the resource sector, but overall, they're really much of a muchness. They follow each other, so I'd be quite positive on the banking sector.
Okay, so positive from John. How about you, Gary?
And reasonably positive, yeah.
Oh, excellent.
NAB was one of the lenders in the Dick Smith thing that the...
Yes, NAB, HSBC, and there was one other one. I forget the other lender.
Yes, and so that'll turn up somewhere on their balance sheet. But yes, I like the banks, and I also like Bendigo Bank as well.
Okay, so the regional is Bendigo out in Adelaide. What do you think of Bendigo in Adelaide or Bank of Queensland?
I'm also a fan of the regional banks as well.
Wow, we've got agreement. This is great. So liking the banks for 2016. It's been hard for 2015, so I'm sure a lot of investors happy to hear that. And it is time for a short break. We'll be back with more of your calls in just a moment. Welcome back to the special 2-hour extended edition of Your Money, Your Call. I'm Julia Lee from Bell Direct, and with me on the panel tonight we have John Athanasiou from Redleaf Securities and also Gary Burton from FP Markets. And we are still here for another half hour answering your questions, so please give us a call. The number's 1300 30 34 35, or you can email us yourmoney@skynews.com.au. And we have another caller on the line. Let's go straight to Andrew from Sydney. Andrew, thanks for calling in. How can we help you?
Oh, thanks, Julia. Look, I'm just wondering about the 10 network. They've gone through quite a quite a slide in the share price, but there seems to be some stability, and also they seem to have some great programs like the Big Bash. So interested to see what the panel's got to say.
Sure. So having a look at 10, and certainly from a programming point of view, things are much better than they were a few years ago. The media space also looking quite interesting, I think, because of the reach rule and the possibility that we're going to see that reach rule disappear, which will see more consolidation and merger and acquisition activity in this space. 10 also looking at a consolidation of shares. So for every 10 shares you own, that will become 1 share. So today the shares finished up at $16. No, I wish $16. 16.5 cents. And after the consolidation, 1 share would be $1.65, but that 1 share representing 10 current shares. I'd be interested to get Gary's view technically, especially in terms of the psychology of consolidations, whether they tend to work, and what you think will happen to 10's share price.
Yeah, consolidations often do tend to work because it brings the price of the share into a different class of investor, and they tend to look at it. There are many that won't look at anything under 50 cents or under $1. So it brings it out of this speculative sort of, for want of a better word, a day trader area with these low price stocks. So, but 10 itself, when you look at the chart, it's in a primary downtrend. It really hasn't recovered anywhere when it had the potential takeover some months ago, and it really hasn't recovered out of that. It set a new low just recently, just under 16 cents, and so once it consolidates, then we'll see where it's going to go.
Okay, I mean, it's been a difficult road, but some of the programming decisions seem to be gaining a little bit of traction. Would you be backing 10 at these prices, John?
Well, I have to admit, I do like their programming. I mean, particularly when you got someone like Chris Gale saying controversial things like, don't blush, baby. But the Big Bash has been an absolute winner. So that's probably going to help push up the price up in the short term. Overall, though, it is such a tough sector, like with things like Presto, Netflix. You really need good live sporting content, to excel in this area. Fortunately for 10, they have the rights to the Big Bash. It's been a phenomenal success. But what other live sporting events do they have? It's really Channel 9 with the Rugby League and 7 with the AFL. So overall, I'm not really a big fan of 10. They're having a bit of a, Indian summer, so to speak, with the Big Bash League. But other than that, It's only that show and Master Chef, really.
Oh, I like The Bachelorette.
Oh, The Bachelorette, sorry. Yeah. I only watch stuff on Foxtel. But anyway.
That's right. Foxtel has taken a strategic stake now, just under 25% stake for about $77 million. But, the stock hasn't paid a dividend in 4 years. That's 10 shares. And, the share price is sort of languishing. Would you be interested at all in these?
No, not really. No, but I stress again, once it consolidates, it comes into a different class of investor trader, and then it will get interesting. And I agree with all the comments there that their programming has dramatically improved over the last, particularly in this recent months, and over what they presented a few years ago. So they seem to be finding their feet here under better management anyway.
Okay, and I think the steps to 10 strategic turnaround, which it's in the process of doing, is starting to bear fruits. You're seeing better programming. The next step, which comes later on and tends to lag the programming and the ratings upgrade, is advertising revenue, which flows through, and then a bit more in terms of financial performance and perhaps that dividend being reinstated. But it is a long ride. 10 sort of getting a little bit of traction there in the first part, which is a ratings turnaround, but it does need to see more of an uptick in the second area, which is getting the dollars in and perhaps reinstating that dividend for some of the shareholders when it can. Let's go to our next call. I've got Harry from the Gold Coast on the line. Harry, welcome. How can we help you?
How do you do?
Good. How are you doing?
Not too badly, thanks. Look, the two companies I'm interested in, Coca-Cola and Treasury Wines, and a third one for something Acorn.
Sure. So having a look at Coca-Cola Amatil and Treasury Wine Estates, both in the beverage area, perhaps in different areas. Treasury Wine Estate is just recently making an acquisition of Diageo, so concentrating on wine. Diageo has its assets in the US as well as primarily in the UK, and its wine portfolio has been doing exceptionally well, but Diageo just wasn't getting too much out of it. It represented about 3% of group sales. So maybe Treasury Wine Estates can, get more out of those assets. And looking at that chart, it's a great looking chart. TWE is the stock code there. We might start off with a technical view. The momentum seems to be there in terms of earnings and in terms of this turnaround and in terms of that price action. Would you be keeping with that momentum, or are you cautious that it's gone too far too quickly?
It has gone a long way out of $5.50, but again, a big reversal pattern in the background. If this consolidates here above $7.50, it'll be terrific for this stock, and you'd be looking for the trend to continue on that. And this is one that surprised me. I thought this stock had just about been written off, and I was making notes to clients to basically get ready to sell, and here we are. It's popped out of there, and it's doing quite well.
And I guess this is the power of a good turnaround, and Treasury Wine Estate has been an outstanding turnaround story. I mean, it wasn't too long ago where we were talking about basically pouring down the drain, all that short-term wine that had been stored for too long. It's now got its focus on the premium brands. It's made this acquisition of Diageo. Would you be buying Treasury Wine Estates at these levels?
I do like Treasury Wine. It also benefits from a low Aussie dollar. So that makes the taste of the wine a little bit more pleasing to our foreigners out there who pick them up. So yeah, at these levels, I'm quite comfortable. The chart there does look pretty good. So I'll be quite comfortable acquiring a position there.
I think it's a smart move by Treasury Wine Estates. The US market is interesting in that it's a net importer of wine, unlike Australia, where we have so many producers, but really we don't bring in a lot of wine. So I think the US market is an interesting one for Treasury Wine Estates, and certainly its premium strategy seems to be working. But the other stock chart doesn't look so attractive. It's Coca-Cola Amatil. CCL is the stock code there. We know it's been doing it pretty tough, especially in markets like Indonesia, where there is more competition coming through, and certainly even in markets like Australia, where we are more health conscious. So, John, looking at Coca-Cola Amatil, is now the time to be looking in on this stock? It does have very strong distribution.
It does have great distribution, but the primary concern I have is our changing taste buds, which is far more health conscious, which is reflected in the share price that you see. I'd probably be avoiding it for now. I'd want it to fall around, you know, the $8.50 levels before I'd consider picking up a few. The long-term trend to turn this around seems a little bit difficult for me, given our taste trends as we, you know, are more health conscious.
I admit I don't drink sugary drinks. I prefer to eat my sugar rather than drink it. But you know, Coca-Cola's got this new can which changes colour. It's tempting me to go out and grab one of those hypercolour cans.
Get a bit of caffeine into you.
Yeah. So a no from John. Looking at the share price here,
yes.
What do you think?
This is the big support level on Coke is $9. It trades either side of $9 quite regularly, and today it had a look there again, just a bit over $9. But if there's, I'll just change the subject a little bit. Coca-Cola have made a corporate decision now to become water neutral, where they basically they have the best distribution network in the world, and there's a fabulous documentary on Netflix called Slingshot, and it's about the guy who invented the Segway little transporter device. He's now invented a water machine where you can basically plant it in any third world country, and it'll take the local water and produce clean, clear water very, very cheaply. And Coca-Cola has now agreed to distribute this machine and also incorporate it into their production facilities, where they become water neutral. They had a big issue in India where they were taking too much water out of the local streams, and the farmers were suffering from that. So there's been a change at the top in Coke, and I think if it holds these levels and finds a bit of sentiment change towards the stock, and I think that if $9 is a clear support level on here, so if you're going to buy it, this is the place to pick it up. If it breaks over $9.50, then it's off to have another look at $10 and $10.50. You'd set your stops around $8.60.
Okay, so looking pretty interesting, watching the strategic direction of Coca-Cola. And as you mentioned, you know, the best distribution network in the world. You could be distributing healthy drinks, or even water has been quite popular, although there is that trend away from bottled water as well. And it's interesting because one of the universities over in the US, I think it was Vermont University, actually banned bottled water on its campus. But what it found was that it sold even more bottles through soft drinks, because even though they installed water areas, it became more convenient just to pick up a can. So now they're having to take more measures to actually have biodegradable cups and things like that. So really interesting how something that you think is going to work has a very different effect. I feel like we're talking about the stock market and often things I think are illogical keep on going on and on. We're going to take a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the program. If you have a question about a stock or shares, our phone lines are open on 1300 30 34 35, or you can email us on yourmoney@skynews.com.au. And time is running out because there's only about 10 minutes left on the show. And we've got Paul, who's made it in there from Melbourne. Thanks for your call, Paul. How can we help you out?
Pleasure. Good evening, panel. Look, I've heard you talking about drinking companies, and I have a small exposure to a drinking company called Refresh Group.
Sure.
And excuse the pun, but it's fairly illiquid. And I'm just wondering your thoughts on that company.
Sure. Very small company, so under $10 million market cap here, so I wouldn't even call it a micro cap at these levels, but share price has been moving in the right direction for a few months now. I think it deals in water. It sells water to Woolworths. I think I've seen the brand in Woolworths. You can get the big 5-litre bottles of water, and recently I just noticed that they've announced that they're starting to sell coconut water from Thailand. Chart looks all right. It didn't make a profit last year, so profitability probably more the key question looking at a stock like this, when it is going to bring in that profit. What do you think of this space, John?
Paul, I'm not completely on top of Refresh Group. It is a micro cap, but I do like the fact that it's moved to the coconut water space. That seems to be a trend, particularly amongst, you know, your Northcote, inner suburban Melbourne hipsters will be drinking that stuff. So I'll do a little bit more work before I could put a proper comment there, but I do like the fact that they're in coconut water.
I mean, for me, when I think of a beverage company, the first thing I think about is distribution. And then the next thing I think about with water, and the reason why I guess this ban in terms of universities in the US on banned water bottles is the cost of transportation and everything else. And this company is based in WA, so if you're, sort of got the stuff in WA and then you're trying to transport it to other areas, it's a lot more expensive than a facility, let's say, in Sydney, shipping to Queensland as well as Melbourne. That's just something that comes to my mind. Gary, when you're looking at a stock like this, you'd really want to be a true believer in the company rather than looking at technicals for this type of stuff.
You'd be buying the story more than anything else, and I can't see any growth area, any breakthrough area that they've got a bottling plant in each state in Australia, very small. There was 3 trades on the stock today for a total of 53,000 units. So if you're holding a position on this, you can get caught on the wrong side of this very, very quickly if there's a profit warning comes through or anything goes wrong on the way through. So it's simply you're buying the management skill in a small managed company.
Okay, so in a company this size, it's really about understanding the company, and with a company under $10 million, we're not going to be familiar with the company unless we're actually holding it ourselves, which we're not. So I think with something like this, it's about the story, and if you believe in the story and the profitability, and I guess doing a little bit of extra homework, because you're not going to have any brokers that actually cover the company. So interesting company in that water space, selling to Woolworths, based in WA, RGP is the stock code there. Let's go to our next call. I've got Daniel on the line from Perth. Daniel, welcome to the show. How can I help you today?
Oh, good evening. I've got 2 stocks to ask about, both tied to the US consumer. That's Yowie and Ardent Leisure.
Very good. So Yowie and Ardent Leisure. Yowie, I have to say I still hold, even though it's been undergoing a little bit of volatility over the last few days, and probably is due for a capital raising soon to help fund that expansion over in the US. But who doesn't love chocolates and little toys in chocolates, especially when Kinder Surprise is banned over in the US? They've just come out with a new manufacturing agreement, so they'll be manufacturing over in the US, and they've got a new FDA approval capsule, which gives you a little bit of confidence that their product isn't going to be banned out of the US. So going through with that rollout into Walmart over in the US, and these are the type of stories that I tend to like when you're looking for a big shift in revenue. So when you're going from being, Australian-based company to rolling out to, I think it's about 1,500 stores or something like that over in the US. If it all goes well, there's going to be a jump in profitability. Another company that comes to mind that I bought this week was TFS Corporation, because once again, they made a loss last year. The half year though, they made a profit, and the full year will probably be their first profit. So just those inflection points that you're looking at from a fundamental point of view. However, technically not looking so great, I'm guessing, Gary, because that capital raising, I think, would be on the horizon.
Yes, yeah, it's traded, and this is where the market is really ahead of most of us. This is consolidated for basically 7 or 8 months now at around the dollar, between $1, $1.20. As you mentioned, they started with 50 stores. They've now rolled out into 1,500. They're a growth story in the US. We were talking about this a year ago. I recall we were talking about this a year ago when it was down around 30 and 40 cents, and here it is at $1. So I'd be drawing a line under this if this started to trade below 90 cents. I think the stock's in trouble for the moment. It needs to trade out over $1.20 to break through a resistance level in the short term. So if you're buying the story on this, and I think it's a great story, single license in one of the largest sweets markets in the world, then this is probably the place to be.
And I got it wrong. It wasn't 1,500 Walmart stores. It was 4,300
That's a lot of Walmart stores.
But I think what's weighing on the share price is this expectation of a capital raising. And the longer that weighs on the stock price, the more it's going to have a negative impact. And you kind of wish you'd stay to Yowie, just get it over and done with.
Yeah, everyone anticipates it. Everyone expects it to happen. So, Danny, you'll probably be better off to wait for it to happen before you get involved with Yowie. And just the other thing to take into account with Yowie, everyone got excited when they won the big deal with Walmart, but just bear in mind who wears the pants in that relationship, and it's definitely Walmart, and that's part of the reason why they possibly, very likely, need to raise equity in order to meet the demands of Walmart.
Okay, so you're dealing with a pretty big entity there. Any supermarket that you're dealing with as a supplier can be quite difficult. The other one was Ardent Leisure. Once again, exposure to the US through their main event enterprises, which I guess is an entertainment centre which has things like bowling centres and laser...
cinemas.
What do you call it? No, not laser cinemas, when you go run around with laser guns.
Laser tag. Laser tag.
Laser tag, things like that. So it's, you know, been doing relatively well because of the main event area, but I think the main event really centres around Texas, which, you know, tends to be very much an oil-driven type of state, and of course the cinema business as well. Gary, what do you make of this one?
They're clearly off their highs, and they set a significant lower high during October as well, and here we are back at support at $2.20. This actually looks quite good. The support level looks quite strong on the weekly chart here, and I think if you're going to buy this stock as a speculation, this would be the place to have a look at it, with a very, very tight stop underneath the recent lows around $2.12 would be an ideal place, and you'll find out straight away whether you're right or wrong. But if it's going to recover in price, it's going to do it from this level at this stage.
Okay. And I guess Ardent Leisure has a number of different businesses, but the main thing that's been powering along its share price, I think, in my mind, is Main Event. And the problem is, I think it's 14 out of the 22 main event centres over in the US are in Texas. And we know what's going on with the oil price and also concern around the US economy. What do you think? They also have fitness centres here. I think it's called Good Fit. I don't really exercise, but...
So it's quite diverse business. They also have their cinema business, and you just look at the recent blockbusters that have come out, such as Star Wars. They should really benefit from that. Overall, I'm quite comfortable picking some Ardent at these levels, but I'll also have a tight stop loss as well.
Okay, so looking interesting around these levels, and both our panellists agreeing in terms of Ardent Leisure and Yowie under pressure. Hopefully we'll see a capital raising there, and that sort of clears the air, and there's no other huge underlying issues there. Let's go to an email now. We've got an email here from Paul, and with the Australian dollar falling, is this a good time to invest in companies that deal with travel for inbound tourists? If so, which companies are best positioned to take advantage of this? I'm guessing the answer is yes, and they've already been running. One that comes to mind is Mantra. That's been quite popular over the last few months. Sydney Airport's been popular as well. But Gary, anything else? Yeah, Sydney Airports, the traffic numbers are increasing through Sydney. Flight Centre, it's been found most inbound tourists will take another flight once they're in the country to somewhere. So Flight Centre's also extended their reach back into the US as well, buying a university travel group. But Flight Centre trading around $40, and I think it's broken back into a primary uptrend on here, and looks terrific. Okay, so looking really good for some of those travel-related companies. Which ones do you like, John?
Just the ones that have already been mentioned. I think anything in that particular space will benefit from a low Aussie dollar. If you had to pick one, which one would you pick? Flight Centre, Mantra, Sydney Airports, they're all very different businesses. I would go with Flight Centre out of those ones. Well, just with the inbound traffic coming in, and it's a very good point that you have a second flight. Australia's a big continent. You don't just rock up here and stay in one city or one town. You're going to move around. Okay, and I guess it's a turnaround story after that profit downgrade we saw last year. Gary, which one would be your favourite? I think Sydney Airports, they've got a basic monopoly over the Sydney Airport out there, and Badgerys Creek coming up, they'll certainly have a finger in the pie there. But at the same time, I think Flight Centre is really the quality company in here. Always being cautious of single product companies, but Flight Centre is growing, has a greater reach out there. Technically looks very, very good, well-managed company. Okay, so Flight Centre, and they're on sale now if you're interested in booking a holiday, and a very interesting model. In an age where we are seeing things moving online, it still has a very strong shopfront presence. So you see those stores on the street, and the shares have been in recovery mode.
That's all we have time for today. Thanks so much to our guests for an incredible, longer than movie length show, Your Money, Your Call. We've had John Athanasiou from Red Leaf Securities and also Gary Burton from FP Markets. And to you, our viewers, thanks for tuning in and thanks for all your calls and your emails. Until next week, I'm Julia Lee from Bell Direct. Have a fantastic night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.